Hello, everyone, and thank you so much for being here today. I'm Natalya, President of Custom Accounting CPA, and I'm really glad you could join me because we've got something important and honestly pretty exciting to talk about. Let's be honest, most business owners are great at running their business, but not all of them are great at running their taxes. And that's okay because that's where we comes in. Today, I'm going to walk you through the 10 most expensive tax mistakes that I see business owners make. Mistakes that quietly drain thousands of dollars every year. The good news, every single one of these can be fixed or avoided with the right plan. Think of this as a money saving checklist. If you're doing even one of these things wrong, you are leaving cash on the table for the IRS. And I would much rather see that money in your pocket working for you. By the end of the session, you will know exactly where to look, what to change, and how to keep more of what you have worked so hard to earn. So let's jump in. We will kick things off with a quick intro about custom accounting CPA, dive into the 10 most expensive tax mistakes that cost business owners thousands, and what it means for you, share a special offer that you won't want to miss, and of course, save time for your questions at the end. Our team at Custom Accounting CPA is a team of designated tax strategists who are also licensed CPAs and EAs. We specialize in proactive, forward-thinking tax reduction planning by designing and implementing innovative, customized tax strategies that minimize your taxes and provide a high return on investment by saving tens of thousands of dollars using IRS-approved and court-tested tax strategies. We use our unparalleled knowledge to save successful small business owners, entrepreneurs, doctors, and real estate owners thousands of dollars in taxes every year. We know how to identify special tax credits, uncover hidden deductions, and leverage little-known loopholes to significantly reduce your tax obligations, so you pay as less taxes as legally possible, while also reducing your chances of audit. Are you satisfied with the taxes you pay? Feel free to put yes or no in the chat. Are you confident that you're taking advantage of every available break? Are your tax and investment advisors giving you proactive advice for saving on your taxes? I've got bad news and I've got good news. The bad news is you're right. You do pay too much tax. You are probably not taking advantage of every tax break that you can, as most tax professionals do a compliance work rather than actually saving their clients' money. The good news is you don't have to feel that way. You just need a better plan. Today, we are going to talk about how you can keep more of what you make through utilizing 4 tax planning strategies that are easy to implement, but a lot of business miss on. Before we go deep, as a valued attendees, we prepared a limited time offer for you, free diagnostic meeting with a CPA, a comprehensive review of your latest tax return for missed opportunities, as well as a review of your tax situation as a whole, and providing you with an estimated tax reduction savings that's available to you. This offer is available at no cost to all attendees who books this free diagnostic meeting before the webinar ends. In addition, you will enjoy between $750 to $1,500 reduction in strategy session fee if you become our client from this offer. But you don't have to become a client to receive free consultation, free estimate on savings available to you on tax reduction savings. So you can scan this QR code and register for the scheduled appointment with the CPA. Again, it's free of charge. But let's now dive in. The biggest mistake that most people make when it comes to taxes is failing to plan. And I don't care how good you and your tax preparer are with a stack of receipts on April 15. If you run your own business and you didn't know you could use a medical expense reimbursement plan to write off your kids' braces as a business expense, There is nothing we can do if we haven't set up the plan before the year was over. Tax planning means looking forward to minimize your taxes, not just recording history. What should you do? When should you do it? How should you do it? And tax planning gives you two more powerful advantages. First, it's the key to your financial defenses. You have two ways to put cash in your pocket. Financial offense is making more. Financial defense is spending less. For many of us in this room, taxes are our biggest expense. So it makes sense to focus our financial defense where we spend the most. And second, tax planning guarantees results. You can spend all sorts of time, effort, and money promoting your business or working on your portfolio, but that cannot guarantee results. Or you can set up a medical expense reimbursement plan, deduct your daughter's braces, and guarantee savings. Let's think of the tax code as a series of red lights and green lights. The red lights, places where you have to stop and pay tax. Those include a regular income tax per our current tax brackets, then it's the self-employment tax, and finally the net investment income tax. But very quickly, the code runs out of red lights and starts including green lights. These are places where you can go without paying tax. These are just a few examples. Section 105 makes employer health benefits deductible to employers and tax-free to employees. Section 170 makes charitable gifts deductible, at least for those who itemize. And Section 7702 is what makes cash value life insurance such a powerful retirement planning tool for its tax-free withdrawals. Here is the bottom line. Most tax professionals are so busy doing taxes, they focus on the red lights. And that's very important because blowing through the red lights is what gets you in trouble. But they don't take the time to look for the green lights that can help you pay so much less. Looking for the green lights is what sets us apart from the vast majority of tax professionals. Unfortunately, you lose every time you spend after-tax dollars. That could have been pre-tax dollars. So we are going to spend the rest of this presentation talking about how to turn after-tax dollars into pre-tax dollars. In the end, there are four main buckets of strategies you can use to cut your tax bill. Timing-based strategies, like using 401k deferrals to shift today's tax bill to tomorrow. Income shifting strategies to move taxable income to lower bracket taxpayers like your children. And code-based strategies like Section 105 that may let you deduct your family's medical bill as a business expense. And finally, product-based strategies like separate managed accounts and insurance. We will be focusing today on timing, shifting, and code-based strategies. The second big mistake is nearly as important as the first, and that's fearing the IRS. What does the kind of tax planning we are talking about do to your odds of being audited? The truth is, most experts say it pays to be aggressive. That's because overall audit odds are so low that most legitimate deductions aren't likely to waive red flags. Audit rates actually at historic lows. The IRS primarily targets small businesses, especially sole proprietorships, and cash industries like pizza or coin-operated laundromats with opportunities to hide income and skim profits. In fact, they publish a series of audit guides that you can download from their websites that tell you exactly what they're looking for when they audit your industry. Take a look at the bottom of the chart. You will see that the IRS audits just 0.2% of S corporations and partnerships. If you are really worried about being audited, you might consider reorganizing your business to help fly under the radar. The next mistake is choosing the wrong business entity. Most business owners start as sole proprietors. Then, as they grow, establish a limited liability company or corporation to help protect them from business liability. But choosing the right business entity involves all sorts of tax considerations as well. And many business owners operating with entities that may have been appropriate when they were established, but just don't work as effectively now. I cannot make you an expert in business entities, but I can help you diagnose some common problems that might be costing you taxes that you just don't have to pay. Let's start with one problem I see a lot of business owners make, and that's paying too much self-employment tax. Most businesses start out and tax as sole proprietorships. Even if the owner establishes LLC, they usually elect the default tax treatment, which is disregarded entity. This means the business is taxed as a sole proprietorship. The owner will report the business net income on Schedule C. The business net income is subject to regular income tax. The business net income is also subject to self-employment tax, which is additional 15.3% on the first $176,000, plus 2.9% on everything else, plus an extra 0.9% on amounts over $200,000 for individual filers or to $500,000 for joint filers. Lots of accountants dismiss the self-employment tax, especially once you exceed $176,000 Social Security wage base, but it adds up fast. In our example, we have an owner netting $80,000 and paying $11,304 in self-employment tax before they can even look at their regular income tax. It's worth mentioning that the rules work essentially the same if you are a partner in a partnership. That is to say, okay, we have poll, sorry to interrupt. We have a poll coming up. If you want to participate, would be great. I will share results at the end of the webinar. And it's just a good information for us to know how to help you better. Okay, we'll give it 30 seconds. Okay, I will continue with the slides. So in regard to our examples, that rules are the same for partnership as well. So you pay regular income tax on your partnership income as well as self-employment tax on it as well. Establishing S corporation solves that problem by dividing your net income into two parts, one of which is not subject to self-employment tax. Here is how it works. The corporation will pay you a salary for the services you perform as an employee. You will get a W-2 for that amount, just like any other employee. The rest of the income will pass through to your personal tax return as business income. You will pay regular income tax on both halves, the salary and the business income, just like you did with your sole proprietorship income. You will pay employment tax in the form of FICA withholding on the amount you take as a salary. It's the same 15.3% up to that $176,000 Social Security wage base, plus 2.9% on anything above that, plus 0.9% of wages above $200,000 for individuals and $250,000 for joint filers. And here is where the magic happens. You will avoid employment tax entirely on the amount that passes through to you as business income. Let's say your S corporation earns the same $80,000 as your proprietorship. If you pay yourself $40,000 in wages, you will pay about $6,120 in Social Security. But you will avoid employment tax on the income distribution. And that saves you $5,184 in employment tax that you would have paid without the S corporation. Now let's look at the fine print, because I know what you might be thinking. Why not to pay zero salary or ridiculously low amount like $1,000 a year? Well, the rules require you to pay yourself a reasonable salary for the work you do as an employee for the corporation. And that's not always easy to determine. The IRS and tax court look at several factors when there is dispute over reasonable compensation. And these include the nature of the business, the employee's qualifications, responsibilities, time devoted to the business, compensation compared with non-shareholder employees, amounts comparable businesses pay for comparable services. Every year, IRS Statistics of Income Division publishes spreadsheets reporting all sorts of mind-numbing statistics. This includes the average amount of salary that S corporation owners in aggregate pay in the form of officer compensation versus the amount they take as income dividends. Now, I'm absolutely not suggesting you take the percentage as any sort of guideline or safe harbor. However, I do want you to see that using the S corporation to minimize employment tax is a well-established mainstream planning strategy. At Custom Accounting, we use RC Reports, a cloud-based reasonable compensation analysis tool, to benchmark your role against 12 million wage data points and IRS-approved methodologies. In just minutes, it spits out a reasonable wage and customized defensible report, documentation that stands up as rock-solid audit support if the IRS ever questions your salary. Please put in chat 1 if you are an S Corp and you pay yourself a reasonable salary and the salary is optimized to minimize your taxes and you have documentation to support in the case of audit. Or put 2 if you would be interested to have a reasonable compensation study done for you. If you S corporate owner and you're not sure what your reasonable compensation should be, feel free to put 2 in the chat and we can discuss. And here is something else you will probably like. Remember that chart of audit odds well we looked a few minutes ago? So let's take another look. Organizing your business to be taxed as corporation can significantly lower your risk of getting audited. As you could see, the Schedule C audit percentages varied from 0.9% for returns grossing up to $25,000 to 2.4% for return grossing up to $200,000. S Corp odds, in contrast, were just 0.2%. So there are 2 ways to form a corporation or limited liability company. You will need to register the entity with the state. You will need to get employer ID number, file actual election if you want to be S corporation, which is Form 2553. Everything pretty straightforward. The most important part when you file the S election is to file it on time. You only have 75 days from the day you form it or from the start of the year from which you want to make the election effective. Yes, you can file a late election, but the IRS can easily reject the late election. So it's always the best to get it done on time within 75 days. Now let's talk about qualified business income deduction. In 2017, Congress has created so-called qualified business income, and here is why they needed to do that. The Tax Cuts and Jobs Act lowered the top tax on C corporation income from 35% to 21% in 2017. That's a whole lot less than the maximum 37% tax on pass-through income from sole proprietorship, partnerships, and S corporations. To equalize the tax treatment between taxable and pass-through businesses, C Corp and other entities, the Act defines the new qualified business income and lets you deduct 20% of that income calculated on activity-by-activity basis from your taxable income for the year. So basically, you do not pay tax on the first 20% of your income if you pass through entity. This is only for S corporation, LLC, or partnership. There are 3 important limits to this new deduction. First, if your 2025 taxable income after adjustments to income and itemized deduction is over $197,000 or $394,000 for joint filers, your QBI deduction for each activity is limited to greater or 50% of your W-2 wages or 25% of your W-2 wages plus 2.5% of your tangible property cost. This means that you will need to plan carefully to maximize your deduction if your taxable income before subtracting QBI is enough to phase out the deduction. Second, if your QBI comes from a specified service business, which is medicine, law, accounting, financial services, consulting, performing arts, athletics, or any business that relies on the reputation or skill of one or more employees, your deduction for that activity phases out as your taxable income hits those thresholds that I just mentioned. This may mean that careful planning is required to define specified service income activities from non-specified service income activities in order to make the most of the opportunity. Third, and finally, the overall QBI deduction is limited to 20% of your taxable income in any particular year. When the new rules came out, they immediately suggested several ways to maximize the new benefit. And honestly, the more time tax lawyers and accountants spent looking over these rules, the more ideas they came up with until the IRS shut most of them down. When critics of the tax bill said it would encourage gaming the system, this was the provision they're talking about. This was ground zero for games. But this specifically QBI deduction, really not something do-it-yourself planning. Just because you can do a tool to do something yourself instead of hiring a pro to use it doesn't mean you should, especially and that's specifically for this apply for this situation. Now let's talk about the fifth mistake, choosing the wrong retirement strategy. There are two primary choices for your retirement saving dollars. Traditional retirement accounts, which give you an upfront deduction, but impose taxes on withdrawals. And Roth retirement accounts, which don't give you a deduction today, but let you take money tax-free. Which is the best? The answer may surprise you. Managing money through retirement is a cycle with three phases. There is the seed, your initial investment in the asset or account. There is the growth phase, and there is the harvest. You can pay or avoid tax at each of those points, depending on the nature of the asset you buy or the account you invest in. So which place is the best? It depends on all sorts of factors, and most importantly, including where your personal rates are at any particular point in the cycle. Let's take a look at how the seed, harvest, and growth cycle plays out for different investments. When most of us think of tax advantage investing, we think of IRA or similar accounts that offer upfront deduction for contributions. But common stock, regular taxable stock, offers tax advantages even if you buy it in a regular taxable account. When you buy stock in a regular taxable brokerage account, you're using after-tax dollars. So there is no break on the seed. There is no current tax on the growth. Cash dividends are taxed, but at preferential qualified corporate dividend rates. So we will say there is a partial tax advantage on the growth. When you sell, you will owe tax on that gain, but you won't owe until you sell. If you hold longer than 12 months, you will pay tax at lower capital gain rates. And if you hold stock until your death, your heirs inherit it with a step-up basis equal to the stock fair market value at your death, which means they escape tax on the appreciation entirely. So we will say there is a partial tax advantage on the harvest. When you contribute to a traditional IRA or qualified plan, you generally get to deduct your contribution going in, so your seed is tax-free. There is no current tax as your account appreciates, so your growth gets a break too. When it's time to retire, all bets are off. You may have, say, $500,000 in your account, but the IRS has a lien on your money in the form of taxes that you owe. Your withdrawals are taxable immediately as ordinary income, even if you are withdrawing gains from stock sales that would have been taxed at a lower capital gains rates in a taxable account. At age 73, you have to start taking required minimum distributions, whether you need those money or not. And withdrawals counts towards provisional income for determining tax on Social Security benefits and Medicare premiums. Finally, there is no opportunity to profit from stepped-up basis at death. So there is no tax break on the harvest. In fact, in some cases, your harvest is taxed harder in traditional IRA than if you had invested it in a regular taxable stock account. When you contribute to a Roth IRA or qualified plan, you will pay a regular tax on that income. So there is no advantage for the seed. As with a regular IRA or qualified plan account, there is no current tax as your account appreciates. So your growth gets a break. Finally, withdrawals are generally tax-free regardless of how they would have been taxed in a regular brokerage account. And there is no required minimum distributions as there are with traditional retirement account. So in short, your harvest is tax-free. When you invest in a non-qualifying unit, there is no deduction for the money going in, so no break on the seed. There is no current tax on your growth, so you do get break on the growth. But when you take withdrawals from the contract, they are all taxed as ordinary income. So there is no tax break on the harvest. When you invest in cash value life insurance, there is no deduction for the money going in, no break on the seed, no current tax as you cash value grows. So you do get a break on the growth. Finally, if you choose, you can take tax-free withdrawals of your basis in the account, essentially taking those dollars on a first-in, first-out basis. You can borrow against any remaining cash value tax-free. And at your death, your beneficiaries will take your death benefits tax-free. Cash value life insurance works essentially like a Roth IRA, but without the usual contribution limits or income restrictions. This makes life insurance a powerful retirement planning vehicle, especially if circumstances make contributing to a traditional qualified plan uneconomical. This might be the case, for example, when you run your own business and you want to defer money into a retirement account, but you have a lot of employees you would have to contribute for. Finally, health saving account. Let you put aside money for expenses. The contribution limits aren't especially high. It's $4,300 for singles and $8,550 for families. But health savings accounts are unique in being the only widely available account that gives you tax advantage at each stage in the investing cycle. Money going in deductible, no current tax on your account growth, and withdrawals used for approved medical expenses tax-free. And you don't have to withdraw money right away. You can wait until you're old and you have more medical expenses. The bottom line here is that health saving accounts are the only defined contribution account in the entire tax code that give you a break on the seed, the harvest, and the growth. So how do you know where to take your tax break? The seed, the harvest? The answer is easy, in theory. Which tax will cost more? If the tax you would pay on the seed is more than the tax you would pay on the harvest, take your break on the seed. If the tax you would pay on the seed is less, then take your break on the harvest. And it's easy to calculate the amount of tax you would pay on the seed. The hard part is knowing what the future tax burden on the harvest will be. And that involves two variables. Where will your income be tomorrow relative to where it is today? And where will the tax rate on that income be tomorrow relative to where it is today? Our current system for financing retirement using pre-tax dollars for money going in and deferring tax until money comes out rests on a fundamental premise. Specifically, it assumes that you will be earning your highest income and thus paying taxed at your highest rate when you are stuffing money into your retirement mattress. It also assumes you will be earning less and thus paying tax at a lower rate when you are pulling money out. What's more, it assumes that your relatively smaller contributions going in will be taxed at your top rates, while your larger withdrawals coming out will get benefit of moving up through the brackets before reaching your top marginal rate. And that may be true for most people, but it's not true for everyone. If you're just getting started in your business, for example, you may be earning less right now than you might be in retirement. In that case, you may be better off passing up the current tax deduction, choosing to defer after-tax dollars in a Roth vehicle, and waiting until you are earning more to take advantage of the tax break. If you're a successful business owner earning a high six-figure or even seven-figure income, many advisors would suggest vehicle like a defined benefit plan or cross-tested profit-sharing plan to defer six figures of income per year into retirement accounts. But you may be building enough future income from non-qualified sources that you will never fall out of the top tax bracket. If that's the case, you may not be doing yourself any favors by locking yourself into expensive annual funding requirements and employee contributions. The next question, which may be even harder to estimate, involves future tax rate. Your income could stay rock solid steady from now until the day you die, but if tax rates goes up, you could find a lifetime of diligent savings and careful money management turning into a tax time bomb. While we cannot know for sure what tomorrow's rates will be, we can draw some lessons from history. Right now, our top tax rate is near historic lows. That suggests rates are likelier to go back up over time than they are to come further down. This risk rises as your planning horizon lengthens. But sometimes we can see changes years ahead of time. Even if statutory rates don't go up, effective rates will climb due to the way the IRS adjusts tax for inflation. In 1985, Washington started indexing elements like standard deduction, personal exemptions, tax brackets, so that rising inflation would not push taxpayers into high brackets. The IRS traditionally used the Consumer Price Index to measure inflation. However, in 2017, specified the Tax Cuts and Jobs Acts specified a different index called the Chain Consumer Price Index. This index assumes that as prices go up, consumers react by choosing cheaper goods. Chain CPI rises more slowly compared to the regular CPI. They estimate that changing to chain CPI would increase taxes paid by 30% of the bottom quintile of the income distributions, 70% of the next quintile, and nearly all of the taxpayers in the top 60 of income. Bottom line, switching to chain CPI will function like a small but noticeable annual across-the-board tax hike. Now let's talk about the sixth mistake, missing family employment. Hiring your children and grandchildren can be a great way to cut taxes on your income by shifting it to someone who pays less. Yes, there is a minimum age. For now, at least they have to be 7 years old. I have seen recommendations that you can hire your younger children to serve as for your advertising, but I'm not aware that that particular strategy has been blessed by the IRS or the courts. The first $15,750 of earned income is taxed at zero. That's because it's the standard deduction for a single taxpayer. Even if you claim them as your dependent, the next $11,920 is taxed at just 10%. So you can shift a lot of income downstream. You have to pay them a reasonable wage for the services they perform. The tax court says a reasonable wage is what you would pay a commercial vendor for the same service with an adjustment made for the child's age and experience. So if your 12-year-old son cuts grass for your rental properties, pay him what a landscaping service might charge. If your 15-year-old helps you to keep your books, pay him a bit less than a bookkeeping service might charge. Does anyone have a teenager who helps with your website or social media marketing? They know more about Instagram and TikTok than we ever will. What would you pay a commercial designer for that service? To audit proof your return, write out a job description and keep a timesheet. Pay by check or direct deposit so you can document the payment. You have to deposit a check into account in the child's name, but it doesn't have to be his pizza and Nintendo fund. It can be a Roth IRA for decades of tax-free growth. It can be a Section 529 college savings plan. Or it can be a custodial account that you control until they turn 21. Now, you cannot use money in custodial account for your obligation of parental support, but private schools aren't obligation of parental support. Sleepaway summer camp is not an obligation of parental support. Let's say your teenage daughter wants to spend 2 weeks at horse camp. You can earn the fee yourself, pay tax on it, and pay for camp with after-tax dollars. Or you can pay her to work in your business, deposit the check in her custodial account, and then as custodian, write the check to the camp. Hiring your daughter effectively lets you deduct her camp as a business expense. If you hire your child to work in an unincorporated business, you don't have to withhold for Social Security until they turn 18. So this is really a tax-free money. You will have to issue them a W-2 at the end of the year. But this is painless compared to the tax you will waste if you don't take advantage of this strategy. Let's now talk about healthcare costs. If you pay your own health insurance, you can deduct as an adjustment to income on page 1 of Form 1040, or if you itemize deductions, you can deduct unreimbursed medical and dental expense on Schedule A if they total more than 7.5% of your AGI. But most of us don't spend that much on our healthcare, so we just lose those deductions, unfortunately. But what if there is a way to write off medical bill as a business expense so you don't lose them because of that flaw? There are a couple of ways you can do that. The first one is called a medical expense reimbursement plan or Section 105 plan. The Section 105 plan is an employee benefit plan. That means somebody needs to qualify as an employee. The problem is if you run your business as a sole proprietorship, a partnership, or S corporation, you are considered self-employed and you cannot get benefit from the plan. So you have to figure out another way to qualify. If you are a sole proprietor or single member LLC and you are married, you can hire your spouse. If you are a partner in a partnership, you can hire your spouse so long as they don't own more than 5% of the business. If you're a shareholder in S corporation, you don't qualify and your spouse don't qualify. So your best bet in that situation is to segregate part of your income into a separate entity, such as a proprietorship or a C corporation, and run the medical plan through that entity. So again, S corporation will not qualify, unfortunately, and that's the workaround that I just mentioned. Finally, if you run your own business or even just a part of your overall business as an entity taxed as a C corporation, you do qualify as an employee all by yourself. And you can also use the 105 plan for family members other than your spouse. Let's say you're a single mom working as a real estate agent. You can hire your teenage child and use the plan to pay for their eyeglasses, braces, or other medical costs. You can even hire a retired parent to help cover their medical costs. The plan has to cover all eligible employees. You cannot just cover yourself or your family and exclude everyone else, but there are some exceptions. So you don't have to include in the plan employees under age 25, employees working less than 35 hours per week, employees working less than 9 months per year or who have worked for you for less than 3 years. Now for the benefit. Once you qualify, the plan lets you reimburse your employee for all medical expenses they incur for themselves, their spouse, and their dependents. Let's say you are a married sole proprietor and you hire your spouse. You can reimburse them for all medical expenses they incur for themselves, their spouse, which means you, and your dependent. Now you have taken what would probably have been a non-deductible personal expense and converted it into a business expense. And you have avoided that 7.5% floor on itemized deduction. And if you pay self-employment tax on your net income, you will even avoid paying self-employment tax on the money you deduct through the 105 plan. What exactly can you deduct? Well, pretty much everything you can think of. This includes all the expenses you see listed here: major medical insurance, long-term care coverage, Medicare Part B, D, co-pays, deductibles, prescriptions, dental vision, chiropractor care, braces for your kids, plastic surgery, fertility treatments, special schools for learning disabled children. You can even reimburse for over-the-counter medications, vitamins, herbal supplements, and medical supplies as long as they're actually prescribed by a physician. You will need a written plan document, which we can provide, or there are resources also available online for that. Let's go to home office deduction. This is probably the most misunderstood deduction in the entire tax code. For years, taxpayers fear it and that it will raise automatic audit flag. But Congress has relaxed the rules, so now it's far less likely to attract attention. First, let's talk about how you qualify for the home office deduction in the first place. Your home office qualifies as your principal place of business if you use it exclusively and regularly for administrative or management activities of your traded business, and you have no other fixed location where you conduct substantial administrative or management activities of your business. This is true even if you have another office, so long as you don't use more than occasionally for administrative or management activities. You have to use your office regularly and exclusively for business. Regularly means generally 10-12 hours per week. And to prove your deduction, it's important to keep a log, to take photos, to record your business use. You can claim a workshop, studio, or separately identifiable space you use to store products or samples. The space doesn't have to be an entire room. If you use it for more than one business, both have to qualify to take the deduction. Once you qualify, you can start deducting expenses. First, you will need to determine business use percentage of your home. You can divide by the number of rooms, if they're roughly equal, or calculate the exact percentage of square footage. Next, you will deduct your business use percentage of rent, mortgage interest, property taxes. Also, you will depreciate the business use percentage of your home basis. If you own your home over 39 years as a non-residential property for purposes of this deduction. Finally, you will deduct your business use percentage of utilities, repairs, insurance, garbage pickup, security. If business use percentage for specific expenses differs from business use percentage for the overall home, such as, let's say, high electrical bill for home office equipment, you can claim the difference as direct expense instead of percentage. Claiming a home office can also boost your car and truck deductions. That's because it eliminates non-deductible commuting miles for that business. Now all you commute from your home becomes business expense deductible. Mm-hmm. When it comes time to sell the house, important to know you will have to recapture any depreciation you have taken on the space, and added back to your income, pay tax capped at 25%. However, claiming a home office will not affect your exclusion for tax-free gains if you decide to sell your house in the future. And now let's talk about car and truck expenses. I don't want to take too much time here, but I do want to point out the most common mistake that clients make with these expenses. Usually people take the standard deduction, which is 70 cents per mile in 2025s, but drive very different cars. People drive the wide variety of vehicles, but the deduction is the same for them all. Are you detecting a pattern here? The deduction is the same for everyone, no matter what we drive. Do you think we all spend the same to operate our cars? It might surprise you to see how much it really costs to operate your car. And it's not exactly 70 cents per mile. Every year, AAA publishes a vehicle operating cost survey that you can see on this slide. And the figures you see from the 2024 survey show how much costs vary for driving 15,000 miles per year, depending on the car. But if you take the standard deduction for a car that costs more than 70 cents per mile, you are losing money every time that you turn the key. So do consider the actual expense deduction instead of the mileage. And let's wrap up with everyone's favorite write-off, which is food. The IRS still lets us expense meals when there is a bona fide business purpose. Think clients, prospects, referral partners, or even your team meeting. The catch for 2025 is that only half the tab is deductible. So keep those receipts, but don't expect the whole pie. A few goodies that are 100% deductible, company-wide parties, snacks that you put out for the public, and foods that is literally part of what you sell. Everything else, assume 50% so you are not disappointed. Remember, entertainment, games, concerts, golf fees is still a hard zero, no matter how brilliant the pitch you gave during those events. Hosting at home is totally fair game. Just keep notes on who was there and what you talked about. Location doesn't matter, the business purpose does. Bottom line, eat, meet, keep neat records. The deduction is there, just don't bite off more than 50% of most meals. And you don't need receipts for expense under $75, but you do need to record the 5 pieces of information listed on the slide in your business diary of records, and you should do it as close to daily as possible. The IRS wants to know how much you paid for the meal, the date of the meal, the place where it took place, the business purpose of your discussion, and the business relationship with your guest. Now that you see how business owners miss out on tax breaks, let's talk about the biggest mistake of all. And what is that? As we said earlier, the biggest mistake of all is failing to plan. Have you heard the saying, if you fail to plan, you plan to fail? It's a cliche because it's true. Fortunately, our tax plan service fixes that mistake. We offer a proactive tax planning. We will tell you what to do, when to do it, and how to do it. We start with a free tax assessment where we analyze your current situation. We diagnose your tax problem the way your doctor would diagnose a medical problem. Then we prepare a written tax plan that addresses all of your planning opportunities from your family, your home, your business, and your investments. Some of those strategies may require extra work to implement. In those cases, we are here to manage that for you or refer you to the appropriate specialist. Finally, we are available to review your progress as tax laws and your own financial circumstances changes. If you're serious about taking advantage of the strategies we have discussed today, you owe it to yourself to give it a try. At this point, I would like to open it up for any questions. Just type them into the chat. And also, I would like to remind that we prepared a limited time offer for you, the free diagnostic meeting with the CPA, as well as comprehensive review of your tax situation and providing you with an estimated tax saving that's available to you. This offer is available at no cost to all attendees if booked before the end of this webinar. And in addition, you will enjoy $750 to $1,500 reduction in strategy session fee if you become our client from this offer. Looks like we don't have any questions at this time. However, feel free to reach out by email or phone after the webinar with any questions that might come up later on. We look forward to helping you achieve your financial goals, and bye for now.